Hello and welcome to today's Cabot Wealth webinar, Great Growth and Value Stocks that are poised for immediate upside. I'm your host, Chris Preston, Chief Analyst of the Cabot Wealth Daily Advisory and Managing Editor here at Cabot Wealth Network. With me today is Krista Huff, Chief Analyst of our Cabot Undervalued Stocks Advisor. And today, Krista will be sharing her expert advice on how to combine growth, value, and technical analysis to not only improve your portfolio returns, but also lower your risk. She'll also give you the names of a few growth and value stocks that appear poised for big breakouts. This is an interactive webinar, which means we will be fielding your questions after Krista's presentation. So if you have a question, feel free to ask it at any time, and we will try and get to them, as many of them as time allows once Krista wraps up. And just keep in mind that we cannot offer advice in regards to your own personal investing situation or portfolio. We'll also tell you how to become a Cabot Undervalued Stocks Advisor subscriber with a special discount offer reserved exclusively for today's listeners. But first, let me introduce Krista. Prior to arriving at Cabot Wealth Network in 2015, Krista spent over 20 years working for large global corporations, including 13 years at Morgan Stanley, where she was a vice president and financial advisor. In 2011, she launched a stock market website called Goodfellow, in which the vast majority of her model portfolios outperformed their comparable U.S. market indices. In addition to her investment career, Krista has an extensive political background with the GOP and the Tea Party. She was elected to be a 2008 delegate to the Republican National Convention, has volunteered on many political campaigns, and was a groundbreaking Tea Party leader in Colorado. Most recently, she worked as a lobbyist in Washington, D.C., promoting policies that benefit U.S. jobs and the economy. Krista is a frequent guest on political and financial radio shows across the U.S. and is in negotiations to be featured on a weekly stock market TV show. And since arriving at Cabot Wealth Network in October 2015, Krista has earned her subscribers an average annualized return of 18.1% on all her completed trades. Not bad. So long story short, Krista knows what she's talking about, particularly when it comes to growth and value stocks. So I'll go ahead and step aside so that she can talk. Krista, take it away.
Thank you, Chris, and thank you everyone for attending. I'm happy to be here today, and we'll talk a little bit about the broader stock market before we get to some new investment ideas. You all know that last year was a very interesting year in the stock market. It started with a big run up, and then it fell, and then it recovered, and then it fell, and then it fell again. So it was a crazy year, definitely abnormal. Very early in the year, MarketWatch called me for what they call some daily color. And I told them that the market was about to drop about 10% and that the drop was way overdue. And lo and behold, the market peaked the very next day, and then it fell 10.2% in a breathtaking short amount of time in just 13 days. So that was pretty extreme. I went on to tell them, but don't worry if the market drops, because it'll recover in 3 to 5 months. And the reason I said that is because I've been investing for 31 years and I'm very familiar with stock market corrections and stock market recoveries. So while people like to think about stock market crashes and head for the hills, in reality, we don't get crashes, we generally just get corrections. And a correction is a normal pullback in the stock market, and it's a little bit scary, but they almost always recover within 6 months. And if you go back any decent length of time, you'll see that after these corrections, the market recovers and then starts reaching new highs again. So one thing I do try to encourage people to do is to buy low during market corrections, and certainly not to panic and sell during the corrections, because that doesn't do anybody any good. For 2019, December was really ugly, and I basically encouraged people to hold on to their stocks and that everything would begin turning around on January 2nd. And that wasn't rocket science, because basically tax loss selling was controlling that situation. And once January 2nd came around, there is no more tax loss selling, and all that's left are buyers or potential buyers. And that is what started the market rebound this year. And as you have seen, in the stock market averages, they're in various degrees close to the highs that they reached last August, September, and October. This is what I call a trader's market. When markets rebound, they're going to be the stocks are going to be going up, but they're going to be climbing to prices where they were trading a few months ago, and then they stop. And so what I encourage people to do is pay close attention to those trading ranges, because if they are trading oriented, they can sell when a stock goes up to a previous range, and then they can go buy a different stock that's just starting to rise. And traders can make a lot of money in stock market rebounds like we're experiencing right now. Corporate earnings are looking decent. Last year, they were phenomenal. So you might hear news headlines that are implying that corporate earnings are not good this year. Well, they're not good compared to last year, because last year they were about as high as they've ever been, but that doesn't mean there's anything wrong with corporate earnings this year. I'm still finding lots of stocks that have double-digit earnings growth, and that's really what I focus on. So I'm not having trouble finding good stocks to add to the portfolio as time goes by. One interesting anomaly that I'm finding is that energy stocks, all different kinds of energy stocks, whether it's an exploration and production company or an oil field service company or a refining and marketing company, many of them are expected to have very low earnings growth in 2019, plus or minus 5%. And then a huge jump in profits in 2020, maybe even 50% profit increases or more. So I would encourage people to keep energy stocks on your radar, because as we get closer to 2020, it's just going to be more and more apparent to investors that there will be outsized earnings growth amongst energy companies. There will be a lot of chatter about that from the media, a lot of attention focused on that sector. And so presumably many of the stocks will react and the share prices will go up. So just line up your favorites right now and keep a close eye on them. I'm not saying don't invest in them right now. I'm just saying the situation will likely continue getting better. Regarding the economy, I think that there are two numbers that people should keep an eye on. I know that we are frequently bombarded with information about trade and job numbers and gross domestic product, and we wonder, especially, you know, if we have a life, we have a job, we have a family, we don't want to watch a dozen different economic numbers and try and figure out how it affects our portfolio. So I'm going to give you the two numbers that I think you should use as a rule of thumb. And the first one is gross domestic product, commonly called GDP. And when people talk about, ooh, are we going to have a recession? Well, the definition of a recession is relatively simple: 2 successive quarters of falling GDP. Now, for point of reference, the last 8 quarters, GDP rose between 1.8% and 4.2%. And it does bounce around quite a bit within that range, but we did not get anything that was remotely similar to falling GDP. So as you see headlines from media, from broadcast television, if they are talking about, ooh, are we having a recession? The answer is they don't have a clue, and change the channel, because there's no recession in sight. So when there is, I'll be happy to talk about it. And when a recession comes, it's a normal thing. There is an economic cycle, and recessions are part of that normal economic cycle. And a recession does not mean stocks are going to crash. Everything just adjusts slowly because the economy moves slowly in either direction. And we have lots and lots of time to discuss it and react to it. It won't slap us upside the head all of a sudden. The other number that I would like you to pay attention to is Consumer Price Index. This is the number that everyone talks about when they're talking about inflation. And inflation becomes an important number because when inflation starts rising, that is when the Federal Reserve theoretically increases interest rates. So if you want to know what interest rates are going to do, back up and look and see what the consumer price index is doing. The Federal Reserve likes the consumer price index to rise about 2% per year. And our recent 12-month growth rate on the CPI has been 1.9%. So we're right there at the target level, and we haven't been much higher or lower than the target level for a while. And therefore, I have every reason to believe that interest rates will probably remain stable in the coming months, maybe all year and into next year. Of course, the CPI could change slowly, but it's not going to change rapidly. So right now, I'm not worried about either an inflation or a recession, and I'm not wearing rose-colored glasses. If these numbers get out of control, I will be very happy to talk to you about them and adjust investment strategy as needed. Right now, I'm the chief analyst for Cabot Undervalued Stocks Advisor, and there are 28 stocks in that stock newsletter divided up into 3 different portfolios. The growth portfolio features companies that are focused, which I pick based on their strong earnings growth. And then the growth and income portfolio represents companies that I pick based on both their strong earnings growth and their dividend yield. And then finally, the buy low opportunities portfolio. I do want to pick companies that have strong earnings growth, but at that point, anything goes. I'm basically looking for companies where the share prices have been ridiculously depressed and there's almost nowhere to go but up. Now, that's a little bit of an optimistic phrase, because clearly stocks can go anywhere and sometimes they do. But as long as the earnings growth situation is attractive, I do have every reason to believe that eventually the stock price will follow suit and it will rise. So more specifically, here's how I pick the stocks. There are about 1,100 stocks that I review on a regular basis, sometimes some of them half a dozen times a year, others just once every 1 year or 2 years, depending on what I find when I review them. As I'm going through these 1,100 stocks, I make a list of the ones with the really strong earnings growth. I want to find companies that are expected to see profits, earnings per share, grow 15% or more both this year and next year. When I find those stocks, then I look to see if they have a dividend yield. The dividend is not a requirement, but it can enhance the total return, so it's an important number. And then then I want to look at the price earnings ratio, which is a valuation measure, and I want that number to be lower than the earnings growth rate. So if we have an earnings growth rate of 15% and the price earnings ratio is 18, I'm not going to give that stock a second look. But if the price earnings ratio is 11, then I will say to myself, this is a potential candidate for the portfolio. Now let's go look at the debt level. I learned probably 25 years ago that if you invest in companies that have high debt levels, there are a lot of financial problems that could trip them up, anything from underfunded pensions to an inability to stay current on technology because they literally don't have the money lying around to invest, like when Y2K came along and everybody had to spend a fortune on technology changes. If a company had high debt levels, that would have presented a problem to them. So I like to see the long-term debt to capitalization ratio at 40% or below, and then I feel confident that the company's not going to get into financial trouble. When I find a stock that meets all of those criteria, I add it to what I call my waiting in the wings list. I have a list of stocks. Maybe there are anywhere from 30 to 50 stocks on there at any given point in time, in addition to the stocks that are already in my newsletter. And so when I am ready to add a new stock to the newsletter, first I look at diversification. I don't want to get overweighted in any particular sector. Right now I'm on the verge of being overweighted in the financial sector, so I'm not going to be adding any new financial stocks to the newsletter in the near future until I remove some of the ones that are already there, because I learned long ago that when you get overweighted in your portfolio in any particular sector or industry, that's the time when that sector or industry collapses. And it's just Murphy's Law, and I am not going to do that as far as I can help it. So right now I will go through that list, and I will screen out the financial stocks because I'm already overweighted there, but I might look at healthcare and technology, or even energy, and I will pick the one with the best price chart at that point. And that's where technical analysis comes in, because if I have a list of 25 attractive companies from a fundamental numerical point of view, how do they look on the price chart? In theory, I want to buy the one that looks like it's most likely to go up in the near future. Now, to a certain extent, that's voodoo, right? We're looking at price charts and they might or might not go up, but there are certain patterns that become very recognizable, and they call that technical analysis. And more often than not, those patterns do predict what might happen next with the share price. So I pick the stocks that look like they're most likely to go up in the near future. As Chris pointed out previously, of the stocks that I bought and already sold since I started writing this stock newsletter in October 2015, there have been 80 completed trades, and the average annualized return has been 18.11%. That number was significantly higher prior to the stock market correction in the fourth quarter of 2018. But this is life in the stock market. It ebbs and flows. And so it ebbed, and now hopefully we're going to flow. During the time period that I have been selecting these stocks, 7 of them turned out to be takeover stocks. I think that's probably a slightly higher percentage than maybe the average person's random 80 stock picks, but I think that has a lot to do with the fact that I focus on strong earnings growth, low valuation, and low debt. Because if you can picture yourself being a big company, let's say you are Apple or Disney, and you're looking to buy a smaller company, you want a profitable company. You want a company that doesn't have a big debt burden, because if you buy them, you're taking on their debt burden. So it's just that the numbers that I look for when I buy stocks are often similar to the numbers that big companies look for when they're buying smaller companies. And that's how we lucked out and had 7 takeover stocks so far. And I'm hoping we'll see more of those in the future. In addition to writing the Cabot Undervalued Stocks Advisor, I publish an annual list called Top 10 Stocks to Buy and Hold this year for 2019, and we published that here at Cabot on January 2nd. And just to let you know, through yesterday's market close, that grouping of stocks was up 16.6% year to date, not including dividends, which could have added maybe another 0.5% thus far in the year. That's an excellent number, but it's not a normal number. You know that the market went up a ridiculous amount in the first quarter, and that's why this portfolio is up, a very attractive amount, but it's not going to grow 16% every quarter. But the bigger point of this annual portfolio is to show people that you do not have to trade a lot to do well with stocks. If you buy a portfolio full of very high quality companies such as Netflix and Microsoft, for example, and you just hold those stocks, you can actually do quite well. So that's my goal with that annual portfolio. Within that portfolio this year, the 2 best performers through April 15th were Sleep Number and NXP Semiconductors. And the ironic thing is that Sleep Number crashed today. They reported earnings yesterday afternoon, and I think earnings came in a tiny fraction below expectations, but the stock had been up so much this year, 50% or so, that all the traders just exited. And that's not unusual with a small cap stock. To a large extent, traders buffet that stock when earnings time comes around, and they'll either push the share price way up or way down. So the stock is still up very nicely year to date, but anyone who owns it gulped this morning when they watched the market open, and we'll see what happens next. But there wasn't any bad news per se within the earnings release, and we'll see what happens. In the meantime, the slower performers from that portfolio are Mercury General and Designer Brands, and the numbers still look great at both those companies. So if somebody were looking to buy low on something that didn't perform yet this year, Designer Brands and Mercury General would be two good choices. Now I'll introduce a couple of stocks that
And Krista, before you get to those, let me just hop in and remind people, if you have any questions, feel free to send them in now. We'll get to them once Krista wraps things up. I see some people have already started asking questions, and we will get to those shortly. Anyway, back to you, Krista.
Thanks, Chris. Yeah, and regarding stocks that you or concepts that you might ask me about, stress the concepts for sure. If you have questions about dividends or questions about things that you hear on the news, if you ask me about an individual stock, I might not be able to look up all the numbers really quickly right now. So I might have to ask you to then just send me an email so at my leisure I can look up the real facts about the company. So I'll do what I can on the fly, and I do have access to price charts right now as well. All right, let's look at Adobe Systems. Okay, so when I was going through my waiting in the wings list to find the stocks to recommend today, I found 3 stocks that I like very much, and they all start with the letter A. And I was laughing because it's going to look like I got lazy and stopped after I was researching when I got to the letter B and just like blew it off. But actually, I went through the whole alphabet on my waiting in the wings list, and the 3 great companies I found with the best price charts right now happen to begin with the letter A. So the first one is Adobe Systems. And you all know Adobe. It's a huge software company, large cap stock. The amazing thing about Adobe is it's the gift that keeps on giving. Look at the earnings growth projections for this year and next year, 42% and 24%. Those are phenomenal earnings growth rates, keeping in mind that I would consider 15% to be a really nice number. And it's so unusual for a very large company to keep growing at excessive rates. So Adobe is on a roll. This is a stock that anybody could put into their portfolio and go on sabbatical for 1.5 years and not have to worry about what's going to happen to their stock. This company is going to keep growing. It's a great long-term buy and hold stock, but I also think it'll be good for traders as well, and I'll show you the price chart in a sec. Revenue growth looks to be about 29% and 18% in the next 2 years. Again, those are real strong numbers. I was just reading an analyst report the other day that said the average revenue growth that's expected within the software industry this year is 10%. So Adobe's way ahead of the curve. The share price at about $273, that price is from the other day, but I'm sure it didn't move too much. It's a higher PE stock. So this is for a more experienced growth stock investor. When the fourth quarter market correction came around in 2018, Adobe's share price fell just like everybody else's did. It fell 25%. And you need to understand that when you buy stocks like this, you can watch your money fall 25% in a breathtaking amount of time, and you need to be brave enough to hold on to it and possibly brave enough to buy more while it's low, because you have confidence that this is a high quality company and therefore the stock will recover. If you feel like you can't make that decision, like it would be too scary, then I would say you need to be in a less risky stock, and I'll introduce some of those. But basically, if a company has a big dividend in addition to the strong earnings growth, that's going to be a less risky stock than Adobe, which does not have any dividend at all. Adobe is not in any kind of cycle of share repurchases. The debt levels are moderate. I like the price chart a lot. We'll take a look at that now. This chart goes back a little over a year, and you can see where the stock peaked last fall. Then it had the fourth quarter correction. It's now back up to where it was in August and September. I think the stock will trade here probably for a brief amount of time, and then it'll start reaching all-time highs as it rises above 275. Owning a stock when it's reaching new all-time highs is the most bullish time to own a stock. And that's because there is nobody on the entire planet who owned this stock at some point at a higher price and has been disappointed in its performance and is waiting for it to get back up to a certain price so that they can sell. Every single shareholder at $275 has a profit and they're happy with the stock. And that fuels the upside of the next run up because nobody's unhappy, nobody's looking to sell. So I know that there are people who say, oh no, it's at an all-time high, this is bad. Those people are 100% wrong. You basically always want to own stocks that are at all-time highs. Okay, next, American International Group. Many of our investors will recall that this was a key company in the 2008 financial crisis, and AIG brought the market down, and AIG was a disaster. AIG is no longer that same company. It's time to take off the dark glasses and put on the rose-colored glasses now because things are looking much better. The company had made a lot of transformations in the last decade. There's a new CEO they changed around the product lines. The property and casualty insurance operations are improving. The company is aiming for an underwriting profit in 2019. Now, insurance companies don't have to have underwriting profits, and they don't all have that because a lot of them make their money on their actual portfolio investments, but they can make money in both ways, and that's what AIG is aiming for. They have a good reserve cushion. They are they're expanding their ROE. So a lot of things are going well at AIG, and that's reflected in the earnings per share. They earned $1.17 per share last year and expected to earn $4.35 per share this year, and then $5.02 next year, which represents 15% earnings growth next year. So the numbers, I like them a lot. We have an earnings report coming out on May 6th where they will deliver first quarter results. And if the stock has not risen by then, it's entirely possible that the company will deliver good enough news that that will be the catalyst for the next run up. But frankly, I think the run up already began, and we'll look at the share price in a sec. AIG is a large cap stock. I would like to reiterate that large cap stocks in general are less risky than mid cap or small cap stocks. That's one of the reasons that Sleep Number is down, 20% today. I think that has a market cap of like $1 billion. American AIG has a 40 billion market cap. Very big difference, safer stock, low price earnings ratio, attractive dividend yield of 2.8%. So you get paid while you own it. And they are aggressively repurchasing their shares year after year after year. Let's look at the share price, the stock chart. So you see the stock falling last fall. This would be a classic stock that I would add to my buy low opportunities portfolio. I love the way the stock traded sideways in mid-January through mid-April. And then there was one shakeout there in the middle of February. When you see that chart pattern that looks like a real deep V where the stock plummets and rebounds within about 2 days, that is a very bullish pattern. I realize it looks breathtakingly scary, but it's actually very bullish. And it shows the market that there are enough investors who like this stock that if it falls, they're going to jump all over it and buy shares. You can see a couple days ago, the stock began its run up. So we call that a breakout. When it rose above 44, that was a breakout. And what typically happens, and again, this is one of the reasons I picked this stock. If you look back last year, the bottom of the trading range was about 51, right? Trading ranges aren't often this precise. So this is a wonderful visual. I expect this stock to go back up to 51, which was the bottom of the previous trading range. And then at that point, it will rest. There are a lot of people who owned it at 51, and those people would be like, oh, thank God, my stock's back to 51, I'm going to sell it. And that causes the selling pressure that pushes the share price down for a little while. So in the very short term, I think you could see AIG go to 51. And if you're willing to not be a trader, but hold it longer term, I think in the not too distant future, it'll break past 51 and keep climbing again. The next stock I want to talk about is Access Capital Holdings, another insurance and reinsurance company, a lot of property and casualty business. What's happening in that industry is that the industry had not really raised insurance rates very much for quite a few years. And then they all sort of decided, okay, 2018 came along, let's start raising rates. They're still raising rates, and that's why we're getting these big jumps in profit year over year. After quite a few years, let's say, of more stagnant profits. Access Capital Holdings has strong excess reserves. The pricing trends are continuing into 2019. The CEO is focused specifically on profitability. Sometimes you get a company that's focused more on revenue growth, but this one is actually focused on profitability. And you can go to the website and listen to their most recent presentation where the CEO is talking to analysts. And those are actually excellent presentations where you get a really good idea of how the company is doing and where they're going. Access Capital acquired a company called Nove Group a little while back, might have been in 2017, and they have been achieving their cost synergies ahead of schedule. They're very happy with that acquisition. They are working specifically to improve customer service, make the customer experience more pleasant so that people are more likely to buy their product. They are improving the quality of their investment portfolio, and they are working on controlling costs, which they've been successfully doing with their recent acquisition. Big profit surges are happening this year and next year. This is a mid-cap stock, so it'll be, more volatile than a large cap stock, and probably less volatile than a stock like Sleep Number. It's got a low price earnings ratio, indicating a low valuation. Nice, very attractive dividend. I love all the numbers on Access Capital Holdings, and they've also been aggressively repurchasing stock. 20% of their stock was repurchased in the last 4 years. Looking at the price chart, the stock has been trading sideways for 13 months. It did have that brief downturn in December, but the downturn, it actually wasn't nearly as bad as most stocks during the fourth quarter. It held up pretty well in the October downturn, and then the December downturn, it gave up the ghost, and then it started bouncing back even before January. So there's a lot of price support in Access. More importantly, there are many, many stocks that I follow that are just now beginning to break out of trading ranges, and I have a sense that Access is about to do that as well. If I'm wrong, it's just going to keep trading in the upper 50s for a little while, but I do think it's about to rise. And you get paid to wait. You get the 2.8% dividend. You get a healthy, growing company. And let's see, did they have an earnings report coming up? I think they do, and I think I forgot to put it on the slide, but it's easy enough to look that up for yourself because first quarter reports are coming out for everybody. All right, so that's everything I had to say about the 3 stocks that I was introducing today. And Chris, what else would you like to add?
Yeah, I'll give you a minute to catch your breath before you start asking some questions. In the meantime, let me just tell everyone how you can sign up for Krista's advisory. If you like what you've heard from Krista so far today and are interested in what other stocks she's currently recommending, you can subscribe to her Cabot Undervalued Stocks Advisor by going to cabotwealth.com/undervalued-stocks-webinar. We'll send all this to you in an email eventually, but so it'll make it a little less confusing. But for today's listeners only, we're offering new subscribers a starter subscription to Cabot Undervalued Stocks Advisor for just $1 for the first month. So you can try it out for the first month at just $1. And what you get are regular growth and value stock picks, weekly updates on all the stocks in your portfolio, or excuse me, in Chris's portfolio, and frequent special bulletins on news affecting those stocks, all straight to your email inbox. And again, Chris's subscribers have been treated to an average annual return of 18.1% on all closed trades. If those sound like the kinds of market-beating returns you're looking for, I highly recommend you subscribe to Chris's Advisory now at today's very special price by going to cabotwealth.com/undervalued-stocks-webinar. Now let's get to your questions. Let's see who I'll give the first word to. Noshir, hopefully I'm pronouncing that right, has been waiting very patiently with a few questions. First question, what is your opinion, Krista, about the recent downturn in healthcare stocks? Does that make them a buy or a sell?
Okay, so we had a big drop in healthcare stocks yesterday that the media tied to Bernie Sanders' proposal in his presidential candidacy for Medicare for all. The longer the idea of Medicare for all makes news headlines, the longer it's going to continue to impact healthcare stocks. So, and one important point is people's perceptions about stocks often take over versus the realities. So for example, there are two pharmaceutical stocks in my undervalued stocks advisor portfolios, and those are Alexion Pharmaceuticals and Supernus Pharmaceuticals, and they are very successful companies. However, their share prices went down just as if they had been terrible companies, right? Because people are going to be making decisions in the near term based on any fear that's being generated by Bernie Sanders' proposal. The sooner that his proposal is no longer highlighted in the media, the sooner the cloud will be removed over healthcare stocks. So let's look at the other side of the equation. What if he becomes the Democratic candidate and he's talking about Medicare for all the way up to the presidential election? That would be bad news for healthcare stocks. So I'm not ready to tell people to buy low or to panic and sell, but I will continue to talk about this in my weekly updates, and I will continue to monitor the political news.
Thanks for the question. Here's one from James. James asks, what is your sell discipline? Is it based on fundamentals, or do you see something technical in the charts?
It is mostly based on fundamentals, and there are different pieces of the equation that could trigger a sell decision in my mind. First of all, if the earnings projections start to deteriorate, and that happened recently with WestRock. I sold that company stock on Tuesday morning because the earnings outlook in January had projected 12.5% earnings per share growth this year, and that's a good number. And they also have like a 4% dividend, so you know everything looked good. And then the 12.5% number deteriorated slowly week by week. And if it gets down to a point where it's like 7% or so, I'm very likely to make a sell decision. It's going to depend a little bit on what the following year's earnings projection looks like, but I don't really want to see that number get below 5%. And that's just one little piece of the potential sell equation. If the stock goes up a lot and the PE gets out of control, I might sell. If there's a very distinct trading range, which there often is on the stocks in my buy low opportunities portfolio, I might sell as the stock goes up and retraces a previous trading range. So there's always a specific reason, but it's never random, like, oh no, the stock fell, let's sell it. These are mostly value stocks, and value stocks, you know, the general definition is this is a stock that's not trading near its proper value, and we're going to take advantage of it while it's down. Does it sometimes fall farther? Yes. So that's why I monitor all of the numbers on these stocks and report on them every single week. So if the numbers start to get weak, I pull the plug. But if the stock simply falls for silly reasons, I do not pull the plug, and I will let people know if it looks wise to buy more.
Thanks for the question, James. Here's one from Ken, who's also been waiting patiently. Ken says, the Mueller report appears to be impacting share prices lower. Do you have a comment on that?
That did not occur to me. Let me look really quick and see what the market's doing. No, I don't think the Mueller report is having any effect at all. The S&P is up 0.25% right now. The Dow's up more, the Nasdaq is up less. It looks all normal to me. I would not be quick to tie any of this Mueller investigation stuff to the stock market. The concept of tying the Mueller report to the stock returns has literally not crossed my path, and so I don't think it's going to.
All right, good question, Ken. Question from Rick. While you're looking in the A's, is ANTM starting to show on your radar?
Okay, can you do me a favor and send that question to me? Is that Anthem? Send that question to me on email, please, okay? And I will be happy to give you a pretty quick answer. I remember looking at that stock the other day, and I will have a quick answer once I can, play on my computer.
Okay, let's see. Here's a question from Jim. Is there a minimum market cap of stocks in your portfolio?
No, there is even a micro cap stock in there, Universal Electronics. I have this love-hate relationship with putting small market cap stocks in the portfolio because they have incredible earnings growth potential, right? But there are never any news stories on them, and people get so frustrated in owning them because the stock might move twice during the entire year, and the rest of the time everybody's just twiddling their thumbs wondering what the heck's going on with Universal Electronics. So I know, and the other cool thing about them is that when you have a really healthy, strongly growing, tiny company, these companies become takeover targets. So I love owning them, but I hate holding everybody's hand and encouraging them to wait for something good to happen. So my general suggestion regarding managing your own portfolios, when I talk about diversification among sectors, I also shoot for diversification among market cap sizes, so that if small cap stocks are in favor or out of favor, they're not weighing too heavily either way on your portfolio. So I would just say keep the tiny cap stocks at like 10% of your total portfolio, but not much more than that unless you have a real strong stomach for volatility.
All right, good question. Here's one. At age 73 and retired, what is your recommendation for my stock allocation?
That's going to depend a lot on the amount of your wealth, your goal with the money, and your risk tolerance. So that's a good question for your financial advisor. But if you love owning stocks and you have enough money to live on, and you have enough money to live on if we get a big stock market correction tomorrow, then keep buying and owning stocks. And if you don't have enough money to really fulfill your financial goals, including the dollar amounts that you might want to leave to heirs, then pare back the stocks and go heavily into something that's more safe.
Okay. Question from a different James. Do you have any thoughts on Square stock, SQ?
I do not. If you send me a specific question, like what do you actually want to know about it? Do you own it and want to know the trading range? Are you curious if the earnings growth would fit my parameters? So if you send me a more specific question, I'll be happy to look that up.
Okay. Ken asks, so you haven't gotten into cannabis yet?
And
I think he means stocks.
Okay, yeah, right. I won't be heading into cannabis stocks, largely because these are newer companies, more unproven. So if a cannabis stock crosses my path one day that fits all of my investment parameters, and I feel confident that the management team has been doing this for a long time and et cetera, I will consider it. But generally, if there is a more of a newer startup kind of an industry, there's just too much about it that could go wrong, even legislation and such. So at this point, there are no cannabis stocks that have met my investment criteria, so there are none on my list.
And by the way, we actually have a marijuana/cannabis specific service here at Cabot Wealth. We launched about a year and a half ago that Tim Lutz, our CEO, runs, called Cabot Marijuana Investor. So if you check on the cabotwealth.com website and go to advisories, you can find out information about that advisory there. It's doing quite well. And it's all marijuana and cannabis stocks. Let's see, a question from Paul. Do you expect Disney to continue to grow and be a value stock worth investing in?
Disney has not landed on my list for several years. There's always something about it that where the numbers just don't meet my criteria. So if you send me an email, I will look up the numbers and let you know if there's a specific thing about them that's not good enough, or if the situation is changing and they're starting to become more attractive. I can't recall really if it was a debt issue or if the earnings growth just wasn't good enough. And I have made lots of money on Disney in the past. So I'll be happy to tell you that it looks fantastic if it does. And if it looks like, and sometimes, by the way, someone will ask me about a stock and the numbers won't look great for me, but the chart will look fantastic. And so I'll just tell them, yeah, keep this stock and, you know, use a stop loss to protect your downside. But this stock looks like it's going up another 18% potentially in the next couple of months. So, you know, I'm not like a party pooper when it comes to stocks that don't meet my criteria. If there's a way to make money on something, I'd be happy to discuss it with someone. Yeah. And going back to the cannabis question, and Chris was mentioning Tim Lutz, Cabot Marijuana Investor. I think you'd be hard pressed to find somebody who knows more about cannabis stocks than Tim Lutz. And if you're remotely interested in cannabis stocks, you would absolutely want to subscribe to his newsletter.
Agreed. I think we have time for a couple more questions. Here's one about, Krista, you wrote about Qualcomm yesterday and its new deal with Apple. What are your thoughts on sort of the fallout from that?
Okay, let's see. I wrote that article that got published today about Qualcomm. So it's on the Cabot website. And if you have trouble finding it, just click on daily. It's up in the toolbar, and I think you'll find it. Okay, so Qualcomm was the poster child for the Book of Job in recent years. Just suffering. All these mergers and acquisitions that kept not getting government approval, and the stock kept falling back down, and they couldn't get anything going. And then they were having all these problems with litigation with Apple, not only in US courts, but in courts all over the world. And then suddenly on Tuesday, Apple and Qualcomm shook hands outside of the federal courthouse and decided to drop all of their litigation and work together. It was wonderful financial news. So Qualcomm, which had been expected to grow profits about 4% this year, which was completely ho-hum, suddenly their entire future looks different now. The clouds have cleared. The profit that they're going to make from being the 5G modem chip supplier to Apple is going to be a huge increase in the profits versus the previous projections. They're also getting an undisclosed cash payment from Apple. Lord only knows how big that cash payment is. The only thing about Qualcomm that has a red flag to me is the long-term debt ratio was 77% in the most recent quarter. And that's pretty darn high. However, how much money are they getting from Apple? Will they use it to pay down the debt? How much money will they get from royalties and products? So the stock rose tremendously this week based on the litigation disappearing. If I were interested in Qualcomm, I would wait for a pullback in the share price, which usually happens when a stock goes up a ridiculous amount. It usually comes back down relatively quickly and rests for a while before the run-up begins in earnest. So I would look to be buying that in the low 70s in the near future. However, the last thing I want to say about that is there's no big sin in buying it at the current price. If you have a several-year investment horizon, I think you're going to make money. It's just that I'm always trying to like optimize the price that I can buy something. So like 72 would be an awesome price on Qualcomm.
Okay, I think I'll let this be the last question. What are your thoughts on what types of financials to invest in now, or what niche within the financials are the best type of investment right now?
Okay, absolutely the property and casualty insurance companies. It's no coincidence the two of them showed up on my waiting in the wings list, and I offered those to you today. So I would go for AIG and Access Capital Holdings above any other kind of bank, insurance, brokerage firm, et cetera. So lots of the other financial types of companies are doing well. But property casualty stocks, I think they're in the sweet spot right now. I think you're going to make money in the near term on those.
Great. Well, thanks to everyone for all the good questions. Thank you, Krista. And we appreciate everyone joining us today. And we will be back next month on May 23rd at 2 p.m. Eastern Time with another webinar. It's our next webinar, this time featuring our options trading expert, Jacob Mintz. And you can sign up now for that free webinar. It's titled 7 Tips for Making Money Trading Options Plus 2 Hot Trades Now. Not now, but in a month. By going to cabotwealth.com/webinars. Until then, for Krista Huff and the entire Cabot Wealth Network team, I'm Chris Preston. Thanks again for joining us. See you next time.
Thank you, Chris.
Thank you.